This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perney. Today, we're pleased to welcome on Tim Lyons with Cityside Capital. We're going to be diving into the interesting parts of due diligence when it comes to investing into private placements. They have kind of an interesting product over at Cityside Capital and the way that they operate, and I think it'd be a great insight to have Tim on today. So, Tim, thanks very much for being on with us today. I'd like to kind of get started with maybe a brief introduction of who you are, how you kind of came to be in the position you're in, and we'll kind of go ahead and jump into it from there.
Yeah, so I think it's a pretty cool story. I'm a New York City firefighter. Been doing that for 18 years. Was an ER nurse for about 10 years. That was my side hustle. Then along the way, I had three little girls who are now 12, 9, and 4, and working two jobs. Trading time for money just didn't seem like the right thing to do anymore. So I got into real estate. First, I was a owner. My first property was a 3-unit. Had proof of concept. Wanted to go bigger, faster. So I got into the commercial space. Really loved multifamily. Have now since gone into, majority multifamily, over 6,000 units, and self-storage, and also industrial triple net leases. And today we have Cityside Capital. It's me and my brother Greg. I'm in New York. He's in Virginia. And it's we're a registered we're registered representatives of a broker dealer that focuses on private placement investments for retail investors, 1031 exchange investors, and institutional capital for commercial real estate deals.
Yeah, absolutely. And it's kind of an interesting concept because so many people, we've had on plenty of people that are syndicators that come on here and they have, a particular deal they put together. They're having kind of one thing. We've had, pooled investment fund providers on here talking about, the benefits of doing that. The nature of what you have at Cityside Capital is a little bit divergent from that, and it's kind of unique in how it operates. So maybe give us kind of like a 30,000 foot view of exactly what you put together, because it's kind of interesting. It's the first, people I've talked to that kind of put together something like this in the private space, focus on this market. I've seen it for other, maybe more of the startup and the tech industry, but focus on more of the real estate, the, industrial, triple net, that kind of thing. It's a little bit unique to your market.
So Alex, when somebody has capital to deploy, so a lot of times they have a quote unquote guy, right? They have a financial guy or girl that they talk to, and they basically get tucked into a ETF or mutual fund or something like that, right? But on the inside of everybody, they kind of think they should be doing something in real estate. I want to do real estate, but I don't understand it. Where do I go? How do I start? I'm not going to do it. And it kind of, for me at least, it always, caused a little bit of anxiety, that pit in your stomach. Like, I want to get into real estate. So when it comes to passive investing in real estate, how do you know who to work with? How do you know what a good operator is? How do you know what a good market is? How do you know what a good deal is? And, if you're a high-paid W-2 employee somewhere, maybe you're a surgeon or a lawyer or engineer, whatever, something like that, do you exactly have the time, Alex, to start learning everything? What's the learning curve look like on that? Books and courses and, sometimes it appears impossible. Or maybe you're a small business owner, and you just, you need somebody to take care of this kind of for you. And that's really where we found our niche, is that, we provide due diligence, right, on our issuers or the operators, right? So the people that are putting the deal together, getting the debt on the deal, doing the on-site due diligence, doing the renovations, those are the folks that we work with, and we onboard them onto our platform. And we are kind of saying to ourselves and to our investors, we did a deep dive. We did criminal background checks. We make sure the LLCs are set up and they're in good standing in each state. We make sure that they, the operator or the issuer, that they actually owned the properties they said they owned, and they sold them when they said they sold them. Because, anybody can make, with the world of AI and subscription services, anybody can make a really sexy deal deck look amazing with palm trees and pools and, clubhouses and, put any number that they want to put in. But how do you know that it's legit, right? So that's where we saw a need, because, Alex, we're New Yorkers at heart, my brother and I. So, we have a unique lens through which we look at things. People are pretty much guilty till proven innocent. I'm still working on that. My wife's helping with me with that. But, that's where we found that a lot of people get stuck. And that's where we decided to jump in.
Yeah, fantastic. And that's again kind of something I feel is really unique to the market is that I've dealt with plenty of people that kind of for lack of a better term have kind of a supermarket view of let's say some private placement deals for high techs and startups, but that really is kind of lacking here. And one of the biggest things for investing in these types of projects is due diligence because you're dealing with a lot of money, and you talk about how do you learn that stuff. I mean, I've been doing this for almost 12 years now, and I would consider myself someone capable of reading through and sifting through and, figuring out, what's the smoke, where's the mirror, and, where's the actual meat of the deal. But it took a long time for me to get to that point. And, for someone like you said, that works a W-2 job, how do you get that experience? How do you figure out what to look for? It's tough, and especially with how nuanced some of these things can be. Reading through a PPM, those things can be, I don't think I've ever seen one less than about 70 pages. I mean, they're big documents that have a lot of stuff in there, and to your point exactly, you can make them look. I've seen them, look extremely sexy. They put the palm tree, they put the clubhouse, they put all that kind of fun stuff in there. But, again, where is the truth in all of this and things to look for? So that's kind of one of the things that I wanted to talk to you about today because, I've talked due diligence with some people, but it's really kind of, it's been a little bit more hyper focused. I think the last one that we did, I was talking with a company that they were really interesting, but it was really focused on, what their model was, and they were investing in bridge debt. That's where they went out. They were the bridge debt providers, and their fund was a pooled investment fund. They went out and did bridge debt for commercial real estate and syndications, industrial, light industrial, self storage. It was kind of exactly what you focus on, but they were the bridge debt people. So what I really want to kind of cover today is due diligence, and maybe some of the higher points that people can say, okay, here's some things to look for in kind of illustrating, what is a good path forward. Some of the stuff that I always tell people to look at is, look at the track record of your operators. Do you have too many chefs in the kitchen? Are there 10 GPs? Why that might cause issues. And I want to kind of get your idea on figuring out, what are some high level things that, are, of great importance. And maybe also, I think importantly, so many people put out there, how to do due diligence, and maybe they're missing the mark on some things that they say are super important that aren't as important that people might think of. Because again, one thing that one person says, can certainly be important, but it's not paramount. So maybe let's kind of start from the beginning of, if someone brings you a deal, or if you were telling someone that just said, hey, I want to get involved in this, what are some things to watch out for? Where would you start?
Oh my gosh, Alex, this is like what I talk about every single day because, a lot of people in the last, say, 4 or 5 years have, gotten to the real estate space. They call themselves syndicators because they went to a weekend conference or a week-long conference. They learned all the nuts and bolts, and they come out and they want to raise money from other people to do these big deals. And I think you're starting to see some of them in the news, right? But there's a lot of them on the off-market deals that are taking place right now that got in trouble. They're in over their head. They're out over their skis. Whatever little cliche you want to throw in there, that's what's happening, right? But they had a network of people that they could raise money from. They thought, they were doing the right thing, and they just didn't have the experience, right? So that's where due diligence comes in. And I've been on enough webinars to know now that every single person has conservative underwriting, Alex. I've never heard one person say, I'm going out on a limb here, I have shady underwriting, and this deal is going to be a smoke show, right? So how do you drill down? So the first thing is really, knowing the operator. If you're not working with a group like ours that does our own internal due diligence, then, you really need to talk to people on Bigger Pockets or, at conferences and meetups and say, hey, who have you worked with? What has your experience been? How have they communicated with you? How was the process? Was it seamless? Was it professional? How was their investor communications? Are they paying on time every time? Are the reports accurate? Did you go full cycle? How did you feel when you called the number and want to talk to somebody? I mean, all these things are, you would do if you were going to go to the dentist or the doctor. And now you're talking about $50,000, $100,000 investments with a group that you're probably never maybe even going to meet in the flesh, right? So, as part of that, on top of all the, say, non-negotiable due diligence tactics, like, you want to be in a growth market or that has job growth and population growth and good demographics and household income and in a 1, 3, and 5 mile area. You want to know what the new supply is coming on in the 1, 3, 5 mile area. Is there going to be an absorption problem? All these different things, like those are all non-negotiables on the market and the top down. But from the bottom up, you need to know about the operator. And if you haven't found out anybody that worked with them yet, maybe you can look at their track record, right? Maybe someone who's brand new, unless they're a really good friend or a family member, maybe you want to give them a chance. I don't know. Maybe you have some similarities there. But if you don't know the group, you want to talk to, you want to look at their track record. How many deals have they gone full cycle on? What were the returns? Stuff like that.
Go ahead. Yeah, and I was going to say too, it's always good to, those are always kind of the things that I mention to people of, it's like, hey, where do I start? I tell them the exact same thing, but it always comes down to trust and verify. My big thing that I always kind of point out to people is transparency in the people you're investing with. If they're not willing to, give you, say, hey, do you have some investors that I can talk to? If they've done a good job, they're more than happy to give you people. It's like, yeah, these people absolutely love it. And those people, if they made money, they're always happy to tell other people that they made money too. So, the transparency is something at least that I would kind of hang on that of, again, asking for that from the people, again, the non-negotiables of the market of what you're investing in, because, you don't want to say, oh yeah, we're building, 300 units in the middle of rural Georgia and there's, one manufacturing plant there. It's like, well, yeah, you have a lot of people now, but what happens when that plant says, Florida's giving me a good tax break. We're going to move over into this, part of Florida. You gotta be really cognizant of that. So that was just kind of one thing I wanted to add in on that.
To drill down even further, right? That is huge, right? You want to know, like, if you're not going to travel out to the market and see what the block looks like, see what the neighborhood looks like, Google's great, right? You can find out a ton of information. You can actually type in the address and kind of walk down the street and see it in real time. Are there, burnt out shells of buildings like just down the street from the big fancy place that's going in? Like, do you want to be the pioneer? I don't know. I don't. Maybe you do. But when it comes down to the deal too, is right now in this rising interest rate environment, we have a lot going on. You really want to know about the debt, right? And this is where it gets kind of crazy for people who are trying to be passive. They don't understand the debt products. What's bridge debt? What's agency debt? What's the pros and the cons? Short-term rate caps, all these things. And this is where you really want to dive into the webinar. You want to hop on a call with one of their investor relations folks. And that's kind of what we provide over at Cityside Capital for our investors, so that if they have, after they watch the webinar and go through the PPM and the investor summary, if they have more questions, they want to dive into the deal a little deeper, that's what we love to do here. What's a cap rate? What does cap rate expansion mean? Is there cap rate expansion in the underwriting? How does that affect returns? What kind of debt? What are our options to get out of that debt, in 3 years or 2 years? All these things really drive a deal, because you're going to get in trouble in real estate if you run out of time or you run out of money. Right. And you want to make sure that you are solving for both of those. I just had a call with somebody, one of my investors, and they said, I'm thinking about investing in this deal. They're still doing, equity raising, but they closed 2 months ago. And I said, wait a minute. I said, there's something there. If they're still raising equity after they closed the deal on a Class A building, sexy, in a great state, in a great market that I invest in myself. I said, what kind of reserves do you think that they have? And he's like, oh, that's a good point, right? So you want to have a well-capitalized, well-run machine. And to your point, Alex, when you said, they're 10 GPs, right? 10 general partners. You want to work with a group maybe that's, they live, work, and play in the market they invest in, right? If you live in Minnesota and you're investing in Texas, not the end of the world, but, if you have the right team, but, if you have all your GPs all over the country and that no one is boots on the ground, no one lives in that area, no one can go there in emergency. Those are some of the red flags that we see all the time.
Yeah. And to that point, I would always say people, with how expansive this type of market is, For me, and again, I'd love to get your thoughts on this. I don't necessarily look at that as being, not having someone local to there, but you have to have some type of, you have to have some type of replacement for that. Did they live there for 15 years and now they just happen to move to Florida because, hey, we got no state income tax. It's really nice out here. We love it. Do they have a big track record of investing in, let's say, 5 or 6 deals in that market, and they know it really well? It's one of those kind of things where, as much as you can like these people, as much as they do it, do you want, and to your point, do you want to be part of that first experience? Do you want to be part of their learning curve in that market? And while some people may say yes, and if you have enough capital to, risk that, then awesome for you. You've obviously done well in life. But, to be a good champion of your own capital and understand that these people are going to be stewards of your capital, making sure that you're not kind of, the 101 college course for that particular market is, maybe something good to look for. And again, there are replacements for some of these things, but there are non-negotiables. You don't necessarily have to live there, but you need experience. You need to have been there or have something that can kind of replace that. Now, to kind of transition a little bit, you had mentioned debt, and really that's kind of one of the big focuses of any of these investments right now is debt with, one, the velocity of money in the marketplace with how people are underwriting deals, and two, how much it costs to get this stuff. And the loan products are changing, whereas we previously saw stuff where, a 5-year runoff was, allowed for a good cap rate expansion. And now you're seeing things where it's getting more common to have bridge debt involved in the deal. You're getting stuff where the balloons are coming, sooner. They're having some windows that are going to kind of compress their timelines a lot. So maybe speak to that on some things that people should watch out for. And again, depending on the operator, these things can be done right. Again, like in our pre-call, we talked about, bridge debt, if they have bridge debt, it's not necessarily a deal breaker. If they can use it right, absolutely, it's a great tool for operators to use. But there's some things that need to be looked at. So let's kind of look at the debt side of things on some things to look out for and what these things kind of mean. Because again, we'll probably get people on this podcast that are super familiar with all these terms, but maybe, some of this stuff is a little bit Greek to them. So let's kind of break that down a little bit.
Cool. Yeah. So before the Federal Reserve started raising interest rates, we had a very low interest rate environment, right? The federal funds rate was hovering around, less than 1%, right? So the traditional way to evaluate a project was to secure a 3-year variable rate debt with a rate cap. You can buy what's called a rate cap, which really is a ceiling on how much your interest rate can go above what your going in interest rate was, and that saved a lot of people, right? So, in the event that there was a rise in interest rates, you were capped, and now you can underwrite to that highest rate and still have quote unquote conservative assumptions. During that 3-year period, it's probably interest only. There's probably no prepayment penalty. That's why people use bridge debt, because it's very flexible. People can get in and out without a huge defeasance, or defeasance is like a prepayment penalty that banks use to recapture some of that early, refinanced, penalty. So people would go in for those 3 years. They'd go to do their value add business plan. So maybe they'd renovate units, add washers and dryers, do some landscaping, some painting, redo the roof, redo the pool. And maybe in 18 to 24 months, they would look to refinance into what's called permanent debt or agency debt, which is Fannie and Freddie products. And it's non-recourse. And now you can refi out of that bridge debt into the permanent fixed rate debt, which now has a 30-year or 35-year amortization, where the bridge debt might only have 20, 25, sometimes 30-year amortization. So you bring down your payment, you got a fixed rate debt, and now you're cash flowing. And that's how value add projects tended to work. In today's environment, we've had a ton of new folks enter the space because everybody was making money over the last 3 to 5 years in real estate. It was up and to the right. So there's a lot of inexperience out there. There's a lot of, syndicators that maybe didn't belong doing bigger deals or something like that. So what happened was no one saw the Fed doing this rapid rise in interest rates, right? Up to 5.5%, 5.75. So So people maybe didn't buy rate caps, and they had a great going in, bridge debt product that's say 3.5 or 4.5%. And now, in a matter of a year, they went cash flow negative, and they went deep cash flow negative because now they didn't have a rate cap to save them from the rise in interest rate. And now they have to either do a capital call, which is asking limited partners for more capital to keep the deal afloat, or they got to sell and they got to take a loss. So interest, bridge debt is great for a value add plan. There's no prepayment penalty or a very small prepayment penalty a lot of times. Very flexible. You can buy a rate cap. They're expensive right now, the rate caps. We're talking on a $20 million deal. You might have something like a $800 to $1.5 million cost, one-time cost to buy a rate cap. So, go ahead.
No. I was just addressing my seat.
Okay. So if you buy something, on the flip side, if you're like, man, I really like fixed rate debt because, maybe in your primary residence, you like fixed rate debt and that's what you use. The problem is people don't go into a deal with fixed rate debt a lot of the times because of that prepayment penalty. So that prepayment penalty, or what's called defeasance, might be so cost prohibitive if they want to do a refinance in 18 or 24 months, or if they want to sell in 3 years, if it's a 5-year hold and they have an opportunistic sale at year 3. They might lose millions of dollars in prepayment penalties to the fixed rate loan product. So those are some of the reasons why people use fixed rate debt versus the bridge debt on top of recourse and non-recourse.
Yeah, exactly, and that's there's good points to bring up because a lot of times when people get into multifamily, it's not their first stab at it. The typical linear progression of the investor in real estate is you start in single family, you realize, hey, this is real estate's awesome, and then you go, but it's a lot of work to make my nut on going to single family house or single family house, whereas I could put the same amount of work into potentially investing into 30 or 40 or 50 doors that cash flow roughly the same. And be there. But, coming from the single family side, we hear things like gap funding and bridge debt, and it's, immediately kind of one of those things where you're like, whoa, why is this even a part of it? How bad in the arrears are you with the accounting on this deal that you actually need that? And that's one thing I kind of like to demystify a little bit for people, but especially to your point, when you have a debt product that has a huge prepayment penalty, fixed rate is awesome. Once you get something cash flowing and repositioned and you don't necessarily, want to sell if you're cash flow positive, yeah, it's great. You can lock it up and, it's great, hold it for a long time. But the ability to get into a loan product that does not have that is kind of the reason that is in place in general in the commercial multifamily space. So again, one of the things I like to demystify, especially on, things that people should and shouldn't watch out for, you should absolutely watch out for it. But, if the rate cap buy is going to be such a huge amount of the capital raise, where does that kind of come in? Is that going to go, is that going to directly affect their reserves? Are they raising enough capital to have enough reserves for the project to where it's still going to have the ability to cash flow and reposition like they say they are? Again, things like that are really important to understand from the newer investor side of things. Again, kind of coming in from understanding who you're investing with and what they're putting out there. Now, the next thing I'd like to cover is kind of, what things are, put in there. You can make a big, sexy PPM. It can say a lot of things. But, typically within that, they're going to have to give you a range of expected rates of return. They're going to have to state, our expected rate of returns in this market condition are going to range from X to Y. Now, I typically always tell people, watch out for stuff that seems too good to be true. And, obviously you don't want to invest in something that's overly conservative. If they're saying that, we expect a 3 to 4% or 3 to 5% growth, well, you're barely beating inflation. Or why are they even putting in this work to something that potentially would have such a low expected rate of return? But there's obviously a sweet spot. And again, to preface this, there's nothing's guaranteed in life. Like we've seen over the past year, we went from, one point where basically money was more or less free. They were giving it out. A sustainable economy doesn't run on a Fed funds rate of 1%. I was always kind of baffled by that. You were kind of getting into more realistic, interest rates, but what are some things to look for on that? When they're telling you one thing, let's say you've kind of done your due diligence, what are some things to watch out for? Obviously, if someone says we're going to double your money in 12 months, I would say you're probably better off buying a lottery ticket. But, again, to kind of, what are some things that might be baked in there where you want to really kind of do some more digging, or it might be just a huge red flag when it comes to what they're telling you these things can perform at?
So a couple of things there. Like if people are jamming a deal down your throat, trying to get you to, I only have one more spot left. I only have two more spots left, or, that's a red flag, right? Because they're starving for money and no one should be doing business like that. Number two is, expected rates of return. If it's too good to be true, it's probably too good to be true. Because look at it through this lens. In today, we're recording this mid-August in 2023, right? There's a wide bid-ask divergence in the market right now. Sellers want, yesteryear's prices, and buyers want significant discounts, right? So there's really not a lot trading right now. So how is somebody going to have this unicorn deal all of a sudden that like nobody else can find, right? Especially if they're not a big player, they're a small player. I don't know. To call me crazy, but again, I'm from New York. Everyone's guilty till proven innocent. That's number one, right? Understand what the deal looks like. Why is the deal a unicorn? Did they get it at a great basis? Is there a loan assumption? Is there some sort of seller financing component? Why is the deal a screaming deal? And if you don't understand, you should be able to hop on a call with the operator themselves and say, look, can you walk me through this? Because every other deal I've seen, they're looking at 1.8 or 2.0 equity multiples. You're looking at a 4 or 5 in 36 months. I don't understand how that works. And if they can't talk to you about it, or they can't provide any documentation or their underwriting, then I don't know. Me personally, I might have to walk away. So the other thing is, right now, looking at, you mentioned like 3 to 5%. Why would somebody do that if they can get a risk-free 4% in a money market, or maybe 5 and change on a T-bill, which is liquid, right? And that's a great argument right now. Where do you want to keep your capital? There's so many options. However, if you have a thesis that, supports your real estate investing, whether it's multifamily for us, or self-storage, or industrial, or data centers, or hotels, whatever it might be, and you have a strong conviction in your investing thesis, then to me, you need to lean into that, right? And find a good deal to do that. The other thing I just wanted to touch on real quick is, when you look at assumptions for returns, as a registered representative of a broker dealer, we have our securities licenses. We can't necessarily give you the same return sheet you see on these investor summaries, year 1, year 2, year 3, year 4, and so on. We have to give you what's called a sensitivity analysis, which is a range of possibilities, so that you can kind of see the worst case scenario, the base case, and the best case scenario, to kind of give you an idea. If cap rates move in different directions, what do your returns look like? If rent growth isn't as robust as we said it was going to be, what do your returns look like? So investors can get a really good idea about how certain metrics will move the needle when looking and assessing a return structure.
Yeah, no, those are really great points to look at, because again, it's, everyone wants to make, you don't put your capital somewhere for it to just lose money against inflation, but understanding kind of where those different caveats come in and what you can expect, again, is kind of paramount in looking at this. Now, some other things that
I'm sorry, one more thing. Also, when returns aren't as sexy as they were maybe 18, 24 months ago, how I square this circle for myself and my capital is, look, if you were in the S&P last year in 2020, listen, I still have a 457 plan. I'm still in the stock market myself. But if you had cash in, say, an S&P fund, $100,000, say, at the beginning of 2022, and at the end of 2022, you lost 20%, right? Now your capital account shows $80,000, right? In 2023, say it goes up by 20%, and you feel really good about that. You're like, man, I went down 20% last year, and now I'm right back where I am. I got 20% now. Well, 20% on 80,000 is 96,000, right? So if you keep that in mind, right, just small little shifts like that can really affect your capital count and your basis. In real estate, I'm not saying it doesn't happen, but it's not mark to market every single day like stocks are. So the risk is, hopefully you're with a good operator and a good asset, right, that you don't have a loss, that's going to compound your problems with your returns.
No, those are definitely great things to look at. And I always try to, at least personally look at that, is that, you lose, again, you lose 20% on 100,000, you're at 80, you have to make up more than 20% to get back to your original basis of starting point. So, again, looking at that. And I think that kind of leads into, how these people are analyzing deals. You want experience, but The problem is that you could have a decade of experience in commercial multifamily right now, and again, you're looking at something that just goes up and to the right, like you said. You could basically throw stuff at the wall for the past 10 years, and you really had to be doing some stuff wrong to miss the mark. It's really only in the last 24 months, and even and the crazy thing is, even going through COVID, with how terrible that was. I mean, realistically, we only saw a huge dip for maybe like 5 months. You could still have underwritten a deal during that time, and if 2-year run out, you probably made money. So again, the due diligence on the deal itself is paramount. Because even looking at operators, again, they could have a decade of experience, but no one's really had a whole lot of hardships until now. The market hasn't fundamentally changed. We hadn't seen interest rates really fluctuate more than maybe a point in the better part of 10 years. It's something that I really like to point out to people, is that you can have experience and you can be comfortable, but numbers don't lie. Or I mean, so long as that the people aren't making them up to make them lie for them. You really need to look at this stuff very pragmatically when you analyze a deal. And that kind of leads me into how these things are paid out. There's a lot of different ways that deals will state that they're going to pay out to investors. The thing that you'll see a lot of times is you'll see a preferred rate of return. You might see something like a certain amount of cap on how much a preferred rate of return can pay out, where it's saying, hey, we're going to pay a return on capital of X up into a certain point, and then after that, if you get there, it's going to be a return of capital. There's a lot of different ways that they can structure this, and small words can make a big difference in that. So I kind of have my own opinions about that. I don't necessarily think it's right for me to give it, being in the position we are at Advanta. But what are some thoughts that you have on ways that people can get into trouble with things like that? Small words like return of versus return on. Where do those things kind of fit in a benefit for the investor? Why you might want to turn away from something, and things to look at when it comes to how these things are actually paid out to people.
So yes, those small words do make a big difference. However, there are operators that I know that are big operators, very successful operators, and their goal is to return of capital as soon as possible, right? So whether it's through cash flow distributions monthly, and then they do a refinance in like a year or two, they want to return your capital ASAP, and then they can start enjoying some of the cash flow as well. And that model works for them, right? But as long as look, going into the deal, that they're returning my capital to me, paying a pref, right? And then we're going to start splitting the cash flow down further all along. Other operators will do a return on capital. So let's do an example, right? Say you have $100,000, and so I'll give you an example of a deal that I'm a part of right now. So we have $100,000 invested. It's an 8% preferred return, meaning that the first 8% of cash flow has to go to LP investors, and then anything above that 8% gets split 70-30. 70% to the limited partners or the passive investor, 30% goes to the general partner or the people doing the deal. We had this deal for 2 years. We've been getting all 8%, right? So we haven't had to have a catch up. And now we just had a refinance event where we got returned to us 32%. So I just got $32,000 back into my account, right? That was a return of capital, though, right? That's how it was written in the PPM for a refinance event. So now my capital account goes down to 68,000, right? So going forward, my 8% preferred return isn't on $100,000, it's on $68,000. So once I hit my preferred return on $68,000, then the cash flow gets split 70-30. And we just got a quarterly report from them, and they're saying that the cash flow is going to be in the low to mid-teens, right? So even though they're returning capital to you, right, there's a higher internal rate of return because of the return of capital. You can velocitize that money and put it someplace else now. But as long as you understand the terms behind that and why it's doing that, then you're in a great position.
Yeah, and exactly. And that kind of comes back, a really good point that you kind of alluded to is understanding, you need to understand the deal, but you need to understand your reasoning for wanting to be in the deal. Do you have money that you want to have there? Again, for the $100,000 example, do you want to have that $100,000 parked somewhere where it is going to be for a while? Or are you of the assumption in your investing strategy that you say, hey, I'm happy to make that pref on the 8% preferred return on this for a certain amount of time, getting that capital back out? Because I think another thing that people need to understand is that these are, unlike many things, these are relatively illiquid investments. You buy into these things, they have a lockup that unless you have some type of extenuating circumstance, your money's in there for the duration of, the deal until it gets refied, sold, or you get a return of your entire capital account. So having the ability, again, this needs to go into your strategy because their strategy is just as important as theirs is, if not maybe a little bit more so, of saying, hey, a return of my capital is great because now, I might get to my 70-30 split a little bit sooner because, 8% preferred return on, 68 is a lot easier to make than 100. Well, easier, maybe not a lot. So being able to have that a chunk of cash flow come back out to me and be able to put that into another deal to help with diversification and other things like that can work very well. And again, I've talked to some people that, so long as that it's being disclosed in a way that you understand what's happening, that is, again, important because those small words make a difference. But understanding that subdoc and saying, hey, okay, all of this stuff is alluding to a return on capital. And then, when they have their, breakdown of returns, it says return of, that should be a red flag. If everything is kind of alluding towards, these long-term cash flow metrics and being in a deal for a long time, and they're saying, oh, we're going to start trying to return your capital to either, reduce the amount we're paying the preferred return on, or try to, getting rid of is maybe a strong term, but, reduce the amount of investors we have by paying them out. Again, not just forcing you out and taking your money, but, getting them paid out. Those are things that you should look into as well. Now, one thing that I do like to, look at with this, and it, we didn't really kind of get into it. One thing I'm a big proponent of is looking at, who is drafting this paperwork as well. Attorneys that have a lot of experience. Well, maybe I'll get a little ahead of myself. We can talk about that in a second. But to your point of, things that are mentioned in, the actual returns, what are some things that you would say are, problematic? I said, if it's all alluding to one thing but doing another, what are some things that you might say, hey, if it looks like this but it goes like this, or things to look for in a set of subdocs for an investor? Is there any kind of red flags that jump out if they're, kind of alluding to a certain strategy, but, it's a return of versus return on that people should look out for?
So me personally, I don't love deals that have a refinance baked into the return assumptions, right? If a refinance occurs in a value add deal, say, or a light value add deal, even a heavy value add deal, any kind of deal, if you have to rely on a refinance in year, say, 2 or 3 for the assumptions to work out, that to me is a problem, right? Because think about if you bought a deal 2 or 3 years ago and now you need to refinance today at today's rates, right? That deal is probably going to blow up and there's going to be capital calls, or they might lose the deal, or you might lose money or something like that. Because if a refinance occurs, that is a cherry on top, right? That is that's what we call a home run, and that's just amazing, right? Because the deal should work without the refinance. That's number one. Number two is, standard underwriting a couple of years ago, just 2-3 years ago, before the rates started to rise, you might have reserves of, say, $250 in multifamily for $250 per unit per year. And that was standard, right? That was okay. But right now you might need $400 or $500 in reserves per unit per year. Insurance costs across the entire country are insane right now. So if you underwrote a deal using very, lackadaisical insurance assumptions, you might be having a pause in distributions right now because they're trying to escrow money for their next insurance policy renewal. So all these things, right, is why you need to work with guys and girls, right, just groups, issuers, operators that understand the metrics. And one of my mentors, Russell Gray, says, follow the math and the math will tell you what to do, right? But you have to have, garbage in is garbage out. You have to have good numbers going in to have good numbers on the way out.
Yeah, and that's a really good thing. That's a very easy analogy for people coming from single family to multifamily to understand. If you're investing with someone, and again, and it kind of gets back into, investing with other people, maybe not your own deal. But, let's say you have someone that's investing in a few houses and looking for money. If they're, basing their assumptions on being able to refinance out of hard money, that's a big assumption to make. You're banking on the ability for that to happen. Yeah, you could maybe qualify for it right now, or maybe why couldn't you qualify? Why are you doing it like this and having to go into it risky, trying to make it less risky in the future? Again, I think that's an easy thing for people to understand, and it does definitely cross the bridge of going from single to multifamily pretty easily. Making those assumptions and baking your returns in on an assumed refi. I can't think of a single scenario where that would really kind of be something that would make me feel good investing capital of saying, okay, you're assuming that this is going to work.
And Alex, if it's
Yeah.
a single family deal, right? Say it's a hard money deal, you're using your retirement account to, you have a great friend that has this great flipping business, right? And say he, I don't know, whatever the terms are, I'm going to make them up right now. Say it's, I don't know, 10% and 2 points, right, for a year, a year term. And he's looking to refinance out of your basically, private money lending to bank financing in a year. Well, right now, I don't know, mortgage rates on a single family, non-owner occupied deal, I'm guessing are 7.5 or greater, right? So in his little pro forma, in their pro forma to you, they should be assuming 8.5 or 9% rates. And if the deal still pencils, then I'd say, man, maybe that's a good deal, right? But if he or she is assuming maybe 6.5 or 7 or right on the cusp of what they are today, to me, that's not good enough. There's no risk premium for me to say, yes, this is a great deal.
Yeah, and to get a little bit farther into understanding the deal as because we're coming up, we could. By the way this conversation is going, we could do this for another hour, but my producer's going to chime in and say we got to cap it at about 45. But we kind of a recurring theme is operators understanding what they're doing, and that comes from everything to how they're putting the deal together, what they're why they're selecting the deal and the area that they are, what the positioning is, what the debt is. But one thing specifically that we get into a lot here at Advanta, obviously, is retirement accounts. And one big thing when it comes to, specifically to retirement account investing, is understanding how the tax write-offs flow through. So within any of these big, syndications, typically you're going to see things like accelerated depreciation, cost segregation analysis. If they're not putting those kind of things in there, definitely ask why. Are they trying to save to get that, not pay for a cost seg to get to that 250 reserve per door? That might be something you really want to ask why they're doing that. So the tax planning side of things is huge in this, because it's not how much money you make, it's how much money you keep. And if you're paying it all out to Uncle Sam, great, you made 10%, but after taxes you're making 2, you lost to inflation by 2 points. That's easy math. But one thing I've specifically seen is a deal provider might have a lot of experience, but maybe they don't have experience accepting in retirement plan investors. Well, the actual syndicators of the deal can choose how they allocate the pass-through write-offs to their investors. And I've seen more common, especially with more people getting into it, that the retirement plan investors, they just assume that they're immediately tax exempt, and they don't allocate the write-offs on K1 to pass through to the retirement plan investors. When absolutely, if your IRA is invested in a deal that has debt involved, which, let's be honest, they're not buying these things cash. They're financed. That's again a main component of what we talked about. You either need to, one, ask, hey, why not, and two, say, hey, you need to allocate this to this, because IRAs can be involved in taxable events when there's debt underwriting involved in the deal. If it's a pass through, these things aren't C corps, and I could go on a huge rabbit hole to that extent, but that's something to ask about, because you want to make sure, especially if you're using a retirement plan, individual flesh and blood investors, people with pulses, they're allocating those write-offs towards. But IRAs, especially if you're doing it, you don't want to run into an event where all of a sudden you got the IRS knocking on your door wondering why you never filed 990T for 3 years when you had returns being paid out to you. So that's definitely something that is worth asking. Now, is there ever any event where you would think that a syndicator, again, and some of them just don't realize, they think IRA, they think tax-free, which, again, is not a huge leap to make. But is there any reason that a syndicator would not apply the pass-through write-offs from a cost seg and accelerated depreciation, or the amortization tables equally among people? Maybe kind of get into that, because I think that's, again, kind of a good way to bring this in for a landing, is understanding kind of how those returns come back to you, and why you're getting certain things and other people may not be.
So, Alex, I do not have a PhD in IRAs, but from my understanding, if you use a self-directed and the real estate deal you do uses leverage, you're subject to what's called a UBIT tax or UDFI, right? But a solo 401k under the 401k rules does not have that debt requirement for the UDFI and UBIT. So,
Correct.
Yeah, so you could, as a self-directed, investor, you really kind of want to have that question answered. Like, hey, am I going to get a K1, or is the entity that I invest through going to get a K1, so I can at least have the optionality of using some of those losses, some of those real estate losses, to use against my either capital gains or the UDFI and UBIT taxes. Valid question. And I would say that's where you need to walk through and really kind of pay attention to the PPM, right? Because everything in the whole deal should be spelled out in the PPM or the private placement memorandum, right? There's an operating, you're going to get 3 documents when you do a syndication. You're going to get a PPM, private placement memorandum, an OA or an operating agreement for the entity that's buying the structure, and also the subscription documents, which means how much do you want to invest in this deal and through what facility. Are you going to use cash or IRA or whatever? So those are the 3 documents. But in the PPM, it should be spelled out. If you do not see that on how depreciation benefits are going to be allocated, that's a phone call to the operator or the issuer or someone if you're working with Cityside Capital. Hey, Tim, I see that there's nothing in the PPM or it's not clear. Can you help me understand? Because, if you have a tax strategy and you're investing with your self-directed or your solo 401k, you want to understand how this is going to affect you. The other thing I'm going to stack on top of that, Alex, is some of the funds that we raise capital for here at Cityside Capital, we give our investors the option, if they're using a self-directed IRA, to be taxed as a REIT, right? So now they'll receive a 1098 instead of a K1, and it'll be just simple interest, basically. So every year, the cash flow will be treated as basically simple interest, and then now you're not subject to the UDFI and the UBIT taxes. Yep. So also a great question to operators and issuers: hey, can I elect to be taxed as a REIT instead of just a standard self-directed IRA?
Yeah, and again, that kind of illustrates the benefit of going through someone like what you have put in. That kind of helps to give you that optionality in some of that thing, that understand it to be able to help out with. And one thing I would kind of say, just to kind of to bring this in for a landing, is that if someone has never dealt with IRAs, there's $37 trillion worth of retirement plan assets in the United States. If they're now just opening up to IRAs, and again, they maybe just never really, understood that you could do this. It's becoming more knowledgeable, and, by the efforts of people like Advanta, we're trying to educate people that you can do this. But, where they just, didn't realize that IRAs could be investors in these deals. Are their capital sources drying up? Or are other people saying, hey, we don't want to invest in this deal? Just things to look at. If they're opening themselves up to more new sources of capital, are they hitting home runs and they just want to open this up and get more capital to get more velocity deal flow in their stack? Are they having harder times raising capital and they just haven't experienced these types of investors before? Just some things to look at on a high service level. More often than not, I've seen investors and syndicators just weren't really aware that IRAs could be plugged in this form and fashion. But again, you always need to be very analytical with this, and just because that's what normally is the question, the answer to that question doesn't mean that is always the case. And, you want to make sure you're not in that always, not always the case bucket. We're kind of hitting up on 45 minutes. I think we've covered a lot of great information. I really appreciate you being on today. So again, if people want to, again, have more of a one-stop shop for being able to have someone that's done the due diligence, kind of has a list of vetted deals that they can look at and, deal with someone that's licensed to do that. That's really kind of the service that you offer at Cityside Capital, right?
It is. And just to be clear, so my compliance officer doesn't kill me, I'm not making any recommendations. I'm not giving any advice, right? This is just, the information that I have acquired, and I'm just trying to pass it along to you. But obviously, you have to do your own due diligence. But yes, Cityside Capital, we work with 10 different operators across the United States, across 3 different asset classes: multifamily, self-storage, and industrial triple net leases. And we help cash, retail investors, IRA investors, and 1031 investors, come on into, these larger institutional quality deals.
Great. And if they want to get more information or want to get plugged in with you, how can they reach you?
Yeah, so our website is citysidecap.com. I'm on all the major social media platforms, and our phone number is 516-521-7762.
All right, Tim. Well, thank you very much for being on with us today. My name is Alex Perney, as always, with the Alternative Investing Advantage podcast. Thank you very much for being with us today, and we'll see you on the next one.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.